Hey everyone, in the last video I went over the first level of the conceptual framework, which was the objective of financial reporting and why it's important. So we came to the conclusion that financial reporting is important because it provides information that's useful in making decisions. So now we're going to go over the second level of the conceptual framework. Now if you remember, the second level of the conceptual framework is split between two sections: qualitative characteristics of accounting information and elements of financial statements. So let's go ahead and start with the qualitative characteristics. These can be further broken down into primary qualities and secondary qualities. The primary qualities of accounting information are relevance and reliability. That is to say, accounting information is relevant and reliable. It helps achieve decision usefulness. But how do we know if information is relevant and reliable? Well, the primary qualities can be further broken down into ingredients. So the ingredients of relevance are predictive value, feedback value, and timeliness, while the ingredients of reliability are verifiability, representational faithfulness, and neutrality. So we're going to go into each ingredient in detail. Alright, so predictive value is just what it sounds like. If information helps users predict the outcome of future events, then it's said to have predictive value. Obviously, financial statements are reports of a prior period's transaction and events, so if we can use that information to forecast financial information, we have predictive value. The flip side of that is feedback value. Information is relevant when it helps users confirm or correct prior expectations. This information is said to have feedback value. If, for example, we use a company's 2011 fiscal year financial statements to forecast 2012 fiscal year data, we can use the interim reports issued at the end of every quarter to basically check our forecasts. Finally, in order for information to be relevant, it has to be presented in a timely fashion. This is relative though. If we're an investor and want to analyze a company's financial statements before deciding whether or not to invest in it, we'll most likely use the most recently published financial statements. So it's October 2012 right now. Financial statements for the quarter ended June 30th are more relevant than financial statements for the year ended December 31st. So in order for information to be relevant, it has to have either predictive or feedback value, and it has to be timely. So, like I said before, the three ingredients of reliability are verifiability, representational faithfulness, and neutrality. Information is said to be verifiable when an independent party, given the same data and using the same methods, would obtain similar results. For example, if two different accounting firms were asked to audit a company's financial statements and they reached the same conclusion about the financial statements, then they're verifiable. Now, representational faithfulness. Although the name is long, it's probably the easiest ingredient to remember. It basically means that numbers and descriptions we're reporting are an accurate representation of what actually happened or what actually exists. So in order for information to be reliable, we basically can't lie about it one way or another. And the last ingredient is neutrality. Information has to be neutral and therefore unbiased in order for it to be reliable. For example, if a tobacco company doesn't disclose the details of lawsuits taken against it, along with their financial statements, they're taking a biased position of their financial reporting. They're making their company look like it's in a better position than it actually is, which makes the information biased. So in order for information to be reliable, it has to be verifiable, it has to be representationally faithful, and it has to be neutral. So we know that relevance and reliability are the primary qualities of accounting information. So what are the secondary qualities? The secondary qualities are comparability and consistency. So information for you should be comparable if it's reported in a similar period. This is pretty easy to digest. If we have two companies that we want to compare, the accounting information wouldn't be very useful if we weren't able to compare their financial statements. In order for information to be consistent, companies should use the same accounting policies consistently. They can change methods, but they should remain pretty consistent throughout their financial reporting, meaning that they shouldn't change the way they account for something every year. You might be thinking that if there is a set of rules, then how could a company change their accounting policies at all? Well, the rules provide different ways to account for similar transactions, so companies have some leniency as to how exactly they can do so. So the secondary qualities of accounting information are comparability and consistency. So that was just the first half of the second level. The second half goes over elements of financial statements. We'll be going over all of these elements in much more detail throughout the rest of the course, so I'm just going to give an overview of each element right now. So the first element is assets. Assets in accounting are items that are expected to provide future economic benefit. For example, inventory is an asset because we expect to sell inventory in the future and to receive cash from it. Cash is also used as an asset because we can use it to invest, to purchase inventory, to purchase equipment. Basically, we can do whatever we want with it. Now the next two elements revolve around assets. The next one being liabilities. Liabilities are creditor claims on assets. For example, if we get a loan from the bank, sign a note payable, and use the money to buy a building for office space, there's a creditor claim on the building. The asset would be the building because we expect to derive future benefit from it, and the liability would be the note payable that we sign with the bank because that's our creditor's claim against our asset. The next element is equity. Now, equity, on the other hand, is the residual interest in assets. Equity is the owner's claims on assets. Assets are claimed by either creditors or owners, so after we take away the creditor claims against our assets, which are liabilities, we're left with the residual interest, which is equity. For this reason, equity is also referred to as net assets because they're assets net of liabilities. The next element is investments by and distributions to owners. An example of investments by owners would be if an individual bought stock in a company. They pay cash and receive ownership interest in exchange. On the other hand, if a company chooses to pay out dividends, this is a distribution to owners. Investments increase net assets while distributions decrease net assets. Now, comprehensive income is a term used for changes in equity during a period, except those resulting from investments by and distributions to owners. Now, revenues and gains are closely related, but they're not exactly identical. Revenue is generated when we provide a service or sell a product that's part of our main business. For example, Apple generates revenue from selling iPads. On the other hand, gains are generated when selling an item that is not part of the core business of the company. For example, if Apple sells land to a third party for more than they originally paid for it, they've made a gain on the sale, but it isn't revenue because selling land is not part of the core business that Apple engages in. Expenses are thought to be the cost of generating revenues. The most commonly known expense is cost of goods sold. If we buy an item for $100 from a manufacturer, sell it to a consumer for $200, we would generate $200 of revenue, but we would have an expense of $100, which is the cost of the item. For losses, I want to go back to the example of Apple selling land. Let's say they buy land for $20,000 and sell it for $15,000 after a number of years. They'll end up with a loss on the sale because they received less money from the sale than they had originally paid. Now again, all of these elements are going to be covered in much more detail as we move forward, but this is just an overview of them. So to sum up, the second level of the conceptual framework covers the qualitative characteristics of accounting information and the elements of financial statements. In the next video, we're going to cover the third level of the conceptual framework. If you have any questions, go ahead and leave a comment and be sure to subscribe if you want to keep up with future videos. Until next time, take it easy.